Welcome to Debt Matters.
Good to be here.
We have a very specific number to chew on today, 11 billion pounds.
That is the headline figure, yes.
It's a massive chunk of change. The UK government and the big banks have announced this lending push, and on the surface, it just sounds like the cavalry is arriving. 11 billion pounds pumping into the system. The immediate reaction for most people is, great, everyone is flush with cash, bills get paid, the economy starts moving.
That is certainly the optimist's view.
But we are not here for the optimist's view. We are here for the realist's view. Specifically, if you are a credit manager or a finance director, or really just anyone waiting on an invoice, does this money actually help you?
Or does it just complicate the picture?
Exactly.
And I think it definitely complicates it. You have to look past that big top-line number. This isn't a helicopter drop of cash for everyone. It is, it's targeted capital.
Right. It's aimed squarely at small and medium-sized enterprises, SMEs.
It is, but even more specifically than that, it alters the psychology of the market.
And that is what we really need to unpack. Because when you inject new credit into a B2B environment, you are not just changing bank balances, you are changing leverage. You are changing how a debtor talks to a creditor.
Precisely. B2B debt collection is, at its heart, a negotiation. And when one side of that negotiation suddenly has access, or even just the promise of access, to a new pot of money, the whole dynamic shifts.
How so?
It changes the timeline, it changes the excuses, and crucially, it changes the risk profile if it all goes wrong.
Okay, so before we get into the strategy, the nuts and bolts of how to handle those calls, let's look at the mechanics. Where is this 11 billion count actually coming from? Is this the government writing checks?
No, not directly. This is a commercial arrangement. We are talking about the big five high street players.
The usual suspects.
The usual suspects. NatWest, HSBC UK, Barclays, Lloyds, and Santander. The money is coming from their own balance sheets.
So it's bank money, not taxpayer money.
Correct. But the taxpayer is the safety net, and that is the critical distinction here.
All right, because banks are usually pretty risk-averse. They don't just wake up one morning and decide to throw billions at SMEs without some kind of comfort blanket.
Exactly. And that comfort blanket is UK Export Finance, or UKEF. This whole scheme is predicated on the idea of growth through international trade.
Ah, so there's a catch.
There's a focus. While the lending is for SMEs generally, the sharp focus is on businesses that are exporting or are setting up to export.
So if I'm a local cafe, this probably isn't for me, but if I'm a manufacturer sending widgets to Germany, I'm listening.
You are definitely listening. And here's why the banks are so on board with this. UKEF is guaranteeing up to 80% of these eligible loans.
80%. That's a huge safety margin for a bank. So if the borrower goes bust, the bank gets 80% of their money back from the government guarantee.
That is the mechanism. It de-risks the lending in a big way.
Yeah.
But the real game changer here, and the detail that really matters for anyone in credit control, is the speed.
The speed.
They've introduced a concept called the automatic guarantee.
Automatic is a word that always makes me nervous in finance. It usually implies things are happening without much human oversight.
Well, in this case, it means removing friction. For working capital loans up to $10 million, the banks can apply this UKEF guarantee automatically. They don't need to send a file off to a government department and wait 3 months for a committee to stamp it.
So the bank manager has the authority. If the boxes are ticked, the guarantee is basically active.
Effectively, yes. It creates velocity. We are used to government schemes being, bogged down in red tape. This is designed to move fast. It means that 11 billion isn't just a theoretical number. It is liquidity that can be deployed into accounts very, very quickly.
Okay, so we've established that there's a lot of money and it can move fast. Now let's talk about the so what for the creditor. I'm sitting there, I'm looking at my age debt report. I see this news. Do I start celebrating?
You should probably hold the champagne. There is a concept we often see in these situations we call the illusion of solvency.
Meaning we think everyone is rich just because there's money in the headlines?
Exactly that. The liquidity is not evenly distributed. It is not like rain that falls on every roof. It is a funnel.
And who gets the bucket at the bottom of that funnel?
The export-ready firms. The companies with strong order books, solid forecasts, and, this is crucial, existing healthy relationships with those 5 banks. If you are a company that is already doing well and just looking to grow, you're at the front of the queue.
And if you are a domestic-only firm, or a firm that's already struggling to make payroll,
you might be watching from the sidelines. And this creates a massive divergence in a creditor's ledger. You are going to have a 2-tier customer base almost overnight.
walk me through that. 2 tiers.
Right. So Tier 1 is your funded group. They get the loan. They might use that capital to invest, buy stock, maybe even improve their payment cycles because they suddenly have working capital flexibility. They become better customers.
And Tier 2?
Tier 2 are the ones who don't qualify. Maybe their credit rating is already shot. Maybe they don't export. They are not getting this lifeline. And relatively speaking, they fall further and further behind. As a creditor, you have to be able to spot which category your debtor falls into. You cannot treat them all the same.
And this brings us to the conversation. The actual phone call. I'm chasing payment. The debtor knows this scheme is out there. How does that change what they say to me?
It gives them a new narrative. A debtor who is short on cash usually has to admit weakness. I can't pay you because I don't have the funds. That is a weak negotiating position. It forces them to beg for time.
But now
They can say, I can pay you, but you have to wait for the facility. It completely shifts the leverage. They are no longer broke. They are awaiting drawdown.
that sounds like an incredibly frustrating stall tactic.
Yeah.
It's the 21st century version of the check is in the mail, but the check is actually a government-backed loan application.
It is the ultimate stall tactic. They will say, look, we have this £5 million facility approved in principle with Barclays. It's backed by UKEF. We are just waiting for the paperwork to clear. Don't take legal action now, or you'll spook the bank and then nobody gets paid.
That puts the creditor in a terrible bind. If I sue, I might kill the golden goose. If I wait, I could be waiting forever.
That is the gamble. You will see a shift away from lump sum settlements. Creditors want the full invoice paid now. Debtors will start proposing structured plans. They will link their payment terms to the loan structure.
So they'll say something like,
We can pay you 20% now, and the rest when the UKEF funds clear in 60 days. Time to pay arrangements.
right.
And they will present it as an entirely reasonable request. They will act as if the money is absolutely guaranteed.
But is it guaranteed?
Nothing is guaranteed until it is in your bank account. Speaking to the bank is not the same as having a loan offer. And even having an offer is not the same as a drawdown. There are always conditions.
Let's look at the worst-case scenario, because this is where I think the real danger lies for a trade creditor. We need to talk about the insolvency waterfall.
This is the part that keeps risk managers up at night. Absolutely.
Explain the waterfall for anyone who hasn't had the misery of sitting in a creditor's meeting before.
Okay, so imagine a company fails. It goes into liquidation. There is a pile of assets, machinery, stock, unpaid invoices owed to them. That is a pot of money available to pay everyone they owe money to.
And there is a pecking order for who gets to reach into that pot first.
A very strict hierarchy. And guess who usually sits at the top?
The bank.
The bank, especially with this kind of lending.
So let's play this out. A company is struggling. They owe me, the supplier, say £50,000 for raw materials. They take out one of these new government-backed loans for £2 million to try and grow their way out of trouble.
Right. They get the cash. But that loan is almost certainly secured. The bank will take a floating charge over the assets or a fixed charge over the book bets. They have essentially put a padlock on the company's value that only they have the key for.
And then the company fails anyway?
The company fails. The insolvency practitioner comes in. They sell off the assets. Who gets paid first? The bank. The bank takes its £2 million plus interest and fees.
And what is left for me? The unsecured trade creditor with my £50,000 invoice.
Often nothing, or pennies on the pound. By injecting new secured debt into a company, you are pushing all the unsecured creditors further down the list. The company might have had more cash temporarily, but the structural risk to you, the supplier, has gone up because the very assets you might have relied on to get paid in a liquidation are now pledged to the bank.
That is a crucial point. An infusion of cash into a debtor looks like good news, but if it is secured cash, it actually dilutes your own security.
It creates a barrier, and you have to understand the director's mindset in that final phase when things are getting desperate.
The psychology of the person running the company.
Yes. If you are a director and you are tight on cash, who do you pay? You pay the people who can shut you down immediately. You pay the bank to keep the facility open. You pay HMRC. You pay the critical supplier who delivers the one component you can't live without.
And the supplier of the generic parts. Or the marketing agency who did the work 3 months ago.
They get pushed to the back. That new loan might actually be used to pay off other pressing debts, leaving the historical trade creditors just as exposed as they were before. So simply knowing a debtor has accessed this 11 billion coal scheme is not by itself a comfort. It requires investigation.
Let's get practical then. We know the risks. We know the mechanics. If I'm running a credit control team, what am I doing differently tomorrow morning?
You have to shift from what I call chase mode to credit control mode. Chase mode is just asking, where is my money? Credit control mode is assessing the quality and risk of the debtor.
So what are the specific questions I should be asking when they give me the "we're waiting for the bank" excuse?
You need to drill down. Don't accept vague statements. Ask them directly. Are you applying for a new facility? Is it specifically one of the UKEF-backed schemes? Which bank are you with? What is the decision date you've been given?
You are trying to catch them in a lie, or at least in a bluff.
You are trying to verify reality. If they say, we are speaking to the bank, that means nothing. I can speak to my bank. It doesn't mean they're giving me £1 million. You need to know if they have an offer letter. You need to know the conditions of that offer.
And what about allocation? Is it fair to ask that?
It is a bold question, but you absolutely should ask it. If you get this funding, how is it being allocated? Because if they are borrowing for an international expansion push, that money might be earmarked for marketing in Dubai, not for paying your invoice in Doncaster.
You need to know if the money's for creditor cleanup or just for growth.
Precisely. If it is for growth, you need to ensure your old debt doesn't get left behind as a legacy issue they'll deal with later.
Okay, so aside from asking tough questions, what protective measures can we take contractually?
Look at your terms for any new supply. If a company is leveraging up with new debt, they are increasing their risk profile. You are well within your rights to say, okay, while you wait for this funding, our terms are changing. We need pro forma payments.
It's going to be upfront.
Or PERT payments. Pay 50% now, and we will release the goods. The key is not to ship more product into a black hole of promised funding. And for goodness sake, check your retention of title clauses.
Remind us why that matters so much here.
Retention of title means you still own the goods until you are paid for them. If they go bust and the bank has a charge over all the assets, a solid RT clause is one of the few ways you can march in and take your specific stock back before the bank seizes and sells it. It is your shield against that secured lending risk we talked about.
It is about being tighter all around. Tightening the dispute windows, refreshing the credit checks more often.
Monitoring is absolutely key. Watch the credit ratings like a hawk. Watch for county court judgments, the CCJs. If a company is loading up on debt, the strain often shows in small cracks before the whole dam breaks. Be the first to notice the crack.
Let's flip the script for a moment. We have been talking about the creditors. But what if there is a business owner listening who is on the other side? They are the SME. They are looking at this $11 billion and thinking, this is my chance. What is the advice for them regarding their suppliers?
Credibility is your currency. If you are going for this finance, do not use it as a smokescreen with your suppliers.
So don't promise what you can't deliver.
If you tell a supplier, I will pay you on Friday because the drawdown is on Thursday, you absolutely must pay on Friday. If you miss that deadline, you destroy all trust. And silence is your worst enemy.
Just ghosting the supplier.
Yes. If you go quiet while waiting for the bank, the supplier assumes the worst. They assume you are insolvent. They will start legal action to protect their own position. You have to communicate the timeline honestly, even if there are delays.
And word gets around, doesn't it, in a supply chain?
The supply chain is a village. If you burn one supplier with a broken promise about bank funding, word travels fast. Suddenly, everyone wants cash up front. You can choke your own cash flow by being dishonest about the lending timeline.
So, to pull this all together, we have £11 billion in new lending capacity. It is targeted at exporters. It is backed by the government. It's designed to move fast.
But for the person waiting to be paid, it is a signal that the ground is moving under their feet.
It is not a silver bullet.
No. It is a tool for growth. For some, yes, but for a creditor, it represents a definite shift in risk. The money is there, but it comes with strings attached. It comes with security that sits ahead of you, and it comes with a new negotiation playbook that you need to be ready to counter.
It really boils down to that fundamental tension in business finance. The bank wants security. The government wants growth. The supplier just wants to get paid for the work they did.
And, more often than not, the supplier is the one with the least protection.
Which leaves us with a thought to mull over, I suppose. When the government guarantees the bank and the bank secures the assets, who's guaranteeing the supplier?
That is the question you have to answer for yourself every single time you ship an order.
Thanks for listening to Debt Matters.